Hi, I'm Ben McVicker, co-head of infrastructure and a portfolio manager at Magellan. I've worked with Magellan now for about 13 years. Prior to that, I worked in investment banking for a number of years. So in total, I've had experience in, call it, financial markets and global listed infrastructure for around 17 years. The investment strategy of the fund is underpinned by our very high quality definition of infrastructure. That means we try to really filter down to things that we think are high quality, reliable businesses. The key way we go about that is by focusing on things with essential services. Essential services are key because when you provide an essential services, what you find is that ultimately people still need your services even if you have a recession. Where we go further is we also require the companies to deliver reliable cash flow. As anyone in investment markets knows, there's a lot of ways you can derail cash flow. The three big risks that we try to avoid are too much commodity price exposure. We think commodity prices are very hard to predict. Too much sovereign risk. We try to work in very rules-based, predictable jurisdictions. And finally, we don't want to take too much competition risk. Typically, these companies are monopolies or oligopoly type businesses. We think the result of that is you get a very stable platform from which to invest. So our key focus when we start to look at businesses is one, the quality of the operations. So we look at things like the balance sheet of the business. We want to see that the high quality business isn't undermined by a stretched balance sheet. The second thing we look for, as I just touched on, is we want to see these companies delivering essential services into their communities and economies. We also want to see very strong evidence of pricing power. In today's world, we know inflation is a persistent feature of broader economies. We want to see that pricing power so that you can offset and retain your real value over time. So the result of this is a portfolio that can offer more predictable, steady structural growth, as well as defensive qualities when the economy or markets get particularly tough. The way we reach the individual weights in the portfolio is by following a rules-based process. So ultimately, what we are seeking to do is we are limiting, for example, individual position sizing at 3%. We cap individual sectors, such as airports, toll roads, at 30% per sector. In addition to which, we also cap regions. So the United States and the EU get a 40% cap, but all other countries get a 15% cap. So ultimately, what that gives you is a much more diversified, broad-based exposure to this high-quality approach to investment in infrastructure. Yeah, we have a large number of companies in the portfolio. Three that I think are really good examples of our particular approach. One would be Aena. Aena is a Spanish airport operation. They do have some international operations. The reason this is a particularly attractive business is, one, in operations in Spain, you tend to have a lot of shorter haul travel. A lot of holiday makers and a lot of travellers coming from Northern Europe and the UK to visit for holidays in the summertime. In addition to which, we tend to find Spain versus other airport regions has a higher percentage of personal travel, so either leisure or visiting friends and family. And in addition to which, we also find that in Spain, you have the advantage that you have a very high low-cost carrier airline penetration. I think as most people appreciate, some of the old airlines are growing slower, whereas the low-cost carriers is where a lot of the growth and capacity additions are in the market. So it's a particularly attractive business from that point of view. Another company is Cellnex. Cellnex is also a European operation, but it's very broad-based. They're a mobile phone tower business, the largest independent one in Europe. They have key operations in places like Spain, France, Italy, the UK and Poland. Why it's an attractive business is because ultimately they get long-term leases. Those typically 10 plus year leases allow them to increase their prices with an annuity-like income that comes attached to that. And as we know, when you think about mobile phone and communication services in today's world, it's critical for our daily lives. The last one I'll mention is Alliant. Alliant is a US Midwest-based utilities business. So at its core, it's a pretty simple business. It's an operation where you have effectively a regulated operation. But the thing we particularly like about Alliant is they're experiencing robust growth for electricity demand. As we know, we're seeing increasing levels of electricity demand in a lot of the developed world at the moment. And that is really leading to these company seeing their opportunity to grow their earnings through capital deployment increasing at the moment. Yeah, we think it's really important for investors to continue to focus on not just getting attractive returns, but doing so with a level of risk that's commensurate with the return you're getting. We think the strategy does that very well. From our perspective, what the strategy delivers to an investor is a couple of things. One is tethers you to long-term structural growth, so you get that rising growth from utilities, electric demand, airport traffic, in addition to which it's highly defensive. And that's really important. And the final piece of the puzzle for us is that when you combine all of this, it tends to be less correlated with broader equity markets. So it's a very healthy diversification tool in portfolios as well.
投資信託なら東京海上アセットマネジメント。